My name is Anthony Fulco. This is Project 1, Finance 695, Investment Strategies, and I did my investment strategy on value investing. All right, so what is value investing? Value investing is a strategy of finding stocks that trade for less than their intrinsic value. Intrinsic value of a stock is its true value. True value of a company is found by looking at all aspects of a business and not just market factors. The true value of a company, it may or may not be its actual market value. The goal of investing, of value investing, is to purchase stocks that are undervalued. All right, so who uses value investing? Berkshire Hathaway CEO Warren Buffett uses value investing methods to choose his stocks. Berkshire Hathaway averaged an annual growth in book value of 19.7% to its shareholders for the last 49 years. Compare that to the S&P 500, who only averaged 9.8% annual growth for its shareholders. That's a 10% difference in growth over almost 50 years. Buffett's current net worth is $63 billion with a B. All right, so what's his secret? Buffett employs 12 tenets or philosophical beliefs. 3 of those beliefs are business tenets, 3 are management tenets, 4 are financial tenets, and 2 are value tenets. All right, now obviously we're not going to go over all 12 of those tenets because the scope of this project is going to be detailed to only 2 of the financial tenets. So our strategy is to basically analyze 2 financial tenets of value investing. All right, 2 of those are high profit margins and high return on equity. Now, profit margins, we know, are the earnings that are kept for every $1 of sales, net income over sales, meaning if you have a 20% profit margin, you've earned 20 cents for every $1 of sales. So value investments, you want to have high profit margins. Also, you want to have high return on equity. ROE is a profitability ratio. It measures how well a company's management creates value for its shareholders. Simple ROE is net income over shareholders' equity. Now, I put ROE distorted metric. Value investing looks at the ROE. It looks for high ROE. However, it's a good metric to look at, but it can be distorted by certain things. For instance, high ROE is typically a positive sign for a company, but it can be ambiguous and it can be misleading. High leverage can distort ROE by inflating its value. Value investors know this, and they look at the leverage aspect of ROE separately, and they're going to choose a company with low leverage. All right, so in more detail about this, we're going to look at an ROE breakdown. This is a 3-step DuPont analysis. We're looking at the net profit margin times asset turnover times equity multiplier. That's your ROE in a nutshell. Down here is what we're looking at, equity multiplier. We're looking for a low equity multiplier. All right, the scope. All right, does low equity multiplier yield higher profit margins? Since ROE can be distorted by leverage, we want to isolate the debt aspect of ROE and use only the equity multiplier for this investment strategy. All right, to determine whether companies that have low debt ratios have higher PMs, profit margins, we need to test to determine if a relationship exists. So, does a relationship exist between leverage and profit? Our null hypothesis is going to be that no statistical significance exists between equity multiplier and profit margins. What I did here is I did a linear regression on the top 18 Berkshire Hathaway holdings by percentage of portfolio. As you can see here, here's all the top 18 holdings. We're looking for a p-value is less than 0.01, implies a statistically significant relationship does exist. For our 18 companies for Berkshire Hathaway, our p-value is 0.008, so it is statistically significant and a relationship does exist, so our null hypothesis is rejected. All right, next I did a linear regression on the 18 companies of the mixed industry that we chose in our class. And you can see here are the 18 companies listed. Again, p-value less than 1 implies a statistically significant relationship does exist. So after applying a linear regression, our p-value is 0.297, not statistically significant, and no relation exists, so the null hypothesis is accepted. All right, next, does lower equity multiplier result in higher PMs? All right, I performed a 2-sample t-test assuming equal variances to compare the means of Berkshire Hathaway and the mixed companies for our industry assignment. All right, the null hypothesis here is that the population means are equal for the two samples. All right, down here you'll see a t-stat greater than 1.65 implies result is statistically significant. The t-stat for our examples were 2.48, so we'll reject the null hypothesis and conclude that the two population means are different. And I don't need the 1.65 t-stat to tell me that. You can look right here and you'll see the average mean for the Berkshire Hathaway profits was 13.08, while the average mean for the mixed industry profits was only 4.31. That's a huge difference. All right, so conclusion. Value investing as an investment strategy can be successful if correctly applied. The regression analysis performed using equity multiplier and profit margin on Berkshire Hathaway companies showed a statistically significant relationship between debt and profit. However, the same test on the 18 random companies showed no statistical significance between debt and profit. Furthermore, our two sample tests showed a statistically significant difference in the profit margin means between the companies. Thank you.